Inflation is showing signs that it has peaked. Hello and welcome back to this week's episode of the Vancouver Life Real Estate Podcast and YouTube channel. Inflation has in fact shown signs that it has peaked. We're going to get into that shortly. Right off the top though, most of the data is in for the month of July here for Vancouver real estate, and we want to get the info to you first. As we all know, the market is moving very fast and we love being timely and getting you the information before anyone else. So let's have a quick look. Right off the top, what the headlines are going to be next week: sales drop 40%. That's about where they look to land for the month of July. We're going to end up under 2,000 units sold this month. This is low. This is basically the lowest since the shutdown. And if you don't want the shutdown to count, we have to go back to January 2020 for factual data of when that low amount of sales last happened. So we're about 2.5 year low here in sales. This July, less sales than July of 2008, if you remember the global financial crisis, and less sales of the last downturn in 2018. It is slow. We only have about 20 years of data to go look back on here. And as far as I could tell, I mean, we're at least a 20-year low in sales for the month of July. I'm sure it goes back a bit further. That'll all wash out shortly. But as you can tell, that's going to be the headline. That's what everyone's going to focus on here. 40% decrease in sales year over year for the month of July. Yeah.
And when we actually talk about inventory as well, you would suspect that with low with low sales, that inventory would just continue to pile on. But that's not the case, which is kind of puzzling, to be quite honest with you. 10,825 currently sitting at our total inventory. It's only about 150 more sales likely to take place before the end of the month, kind of thing, right? So honestly, guys, it's not moving, which is puzzling, I guess. There's still that underlying demand. It's still there, clearly, but that being said, I think there's a wild amount of people who, not just buyers anymore, who are sitting on the sidelines waiting to see what happens, but I think there's a lot of sellers doing the same thing now. I can't figure out why else we wouldn't be climbing in inventory. If sellers are thinking they're not going to get the numbers they want for their homes and they're not going to sell, well, then we're seeing that, right?
Yeah, it really feels like a market freeze right now. People aren't listing and people aren't buying. So it's just a standstill, kind of like what it felt like early pandemic days.
Yeah, I think also, and Dan, you'll touch on it later in the pod, but we have a feeling that, inventory specifically in the GVRD hasn't changed too drastically, but I think where we're seeing a lot of it is going to be in the Fraser Valley, the Sunshine Coast, these outlier communities, not outlier communities, but communities further away from the center of Vancouver, where we're starting to see more volume in terms of inventory.
Exactly. Where the froth was, it's the ones that lose it the quickest as well. Mm-hmm. But let's get into price, because this one is one of the most interesting data points I think that people are going to realize this month. The median price did not move $1 this month.
Wow.
It stayed at exactly $900,000, at least here as we record this on July the 28th. Hasn't moved $1. It's frozen. And this is, again, reminder, we're down 10% over 4 months, but then it just bottomed out. It stopped. That's right. Now, average, basically the same. The average price is $1,210,000. That only dropped $9,000. So less than 1%. So we've really seen at least 1 month of stabilization, but again, this is in a freeze kind of thing, meaning that we're not selling much, we're not listing much, no one's panic selling, no one's panic buying. It's just a standstill. Yeah. So prices have done the same. HPI will definitely drop this month. We know it's a lagging indicator. We know median and average are down about 10% right now. So HPI will start to catch up to that point. Right now, I would expect it to drop about 1.5% next month, which is pretty significant. But again, it is just playing catch up to the median and average. Typically, HPI doesn't lag a lot. It only lags about a couple months. But again, it's a poor representative in a fast changing market. So when the market drops 10% in 4 months and HPI is only down 3 or 4, gives you a good idea of where it's going to go in the upcoming months.
Yeah, I think HPI is probably a better macro indicator than, say, the micro indicators that we've just touched on. But that being said, it's an important metric to keep tabs on. The sales to active ratio, I think you could expect it to be around 18% down. Again, this is, the sentiment of buyers out in the marketplace and sentiment of sellers, right? 18% it's balanced territory, which for the first time since the pandemic shutdown, or January 2020, if we're considering a non-shutdown era, it's been 2.5 years since we've seen some balance. Again, these balanced territories don't tend to last for a long time. So take that for what it is. That being said, though, it may be balanced for a little bit longer, Dan, because the Fed down south just increased the interest rate by 0.75%, continuing the hold and continuing their oversized rate hikes. And honestly speaking, I think we're going to continue to see that come September up here in Canada as well. We'll see something similar. But with that being said, Dan, let's maybe get into some more macro pictures across Canada here and see what's actually taking place across the economy. Generally speaking, are things at their meltdown? Are we at the bottom? Where are we when we look at the big picture here, right? So I think what I'll do is three really big takeaways I think we want to look at here are: where's inflation at? Are we starting to see that kind of pressure ease? There's some indicators that are pointing to that. June home sales, much like we just talked about, and July, just near record drops, right? So we'll talk about that, as well as some immigration, housing starts, and consumer confidence, and kind of the big picture for the real estate market, right? So if we'll first touch on inflation. Obviously, with the huge monster 100 basis point hike that we saw, that was one big part of the inflation story. But what's happened here, and I think something that we should really take into account, the all-important 5-year bond yield, this is the driver for fixed mortgage pricing, is lower today than when the Bank of Canada made their surprise announcement. So we're seeing some form of commodity prices that are starting to come down, right? Which is a nice break from their surge over the last couple of years. So June inflation, while it read 8.1%, and that's the highest since 1983, FYI, but it was actually lower than expected. And when you seasonally adjust it, for month over month, it was 1.1% previously. It's now down to 0.6%. So almost a 50% drop in month over month growth for inflation, at least in the last couple, right? Industrial product prices, this is basically factory goods. It's another great way of looking at supply chain and predicting inflation trends. They just posted their largest monthly decline since the COVID lockdowns in April of 2020, right? And like I touched on earlier, commodity prices, oil, natural gas, copper, agricultural products, they've all fallen by about 15% since mid-June, according to Goldman Sachs. And Canada, lastly, shed 43,000 jobs in June. And the May GDP numbers showed a slight contraction. So we're definitely seeing a big shift here in inflation, right? And Dan, why don't we touch on home sales throughout the nation here?
For sure. So understandably, with interest rates as high as they are and affecting mortgage rates, and there's some charts out there that basically show over the last 10 months, it takes about 55% more money to pay for the same home when you're looking at mortgage payments as it did previously.
Wow.
That's a huge amount of deterioration in your affordability. Massive. I mean, you look at the 4 or 5 years previous, and I think it was only up about 10%. So then 10 months, 55%. It is very hard to see homes not go down in volume as they have, and of course prices as they have begun as well. So we've got some macro data here for Canada that we like to share, and this is now that the June numbers have settled, we're going to share this with you. As we mentioned earlier, GVRD here down about 40% year over year in sales volumes in July. Well, here are some of the fascinating numbers for June in Canada. And again, expect these to be even further accentuated in the month of July as sort of the sales volumes rates are increasing, as in they're going down quickly. Anyway, nationally, 5.6% month over month decline in sales. This brings us down to about the 10-year average, though, because of course things were so blown out previously. We've just settled now down into about a long-term average. It's going to go lower, but today, while it feels slow, it's because we've, just kind of pulled our foot off of that 200 mile an hour gas pedal. Canada, let's look at the year over year numbers. So 24% reduction right now in home sales year over year. BC, this is an interesting one. BC's down 33%. Again, GVRD 40% just last month. So we're going to see this likely increase for the July numbers. And Ontario also hit pretty heavy at 36%. The two provinces that were the hottest are cooling the fastest, understandably. So how does that affect inventory? Well, nationally, we're up about 7% in 1 month, which is quite a bit. Currently sitting at about 125,000 active listings across the country. Remember, though, it was only back in 2015 when that number was double 250,000 active units. So yeah, we're about half of where we were 7 years ago. But yeah, there's probably a couple more million people in the country since then as well. Ontario, their inventory is up 60% year over year. And yes, that's a big number, but let's also remember they had an extremely low baseline to come up from. So yeah, they were under 1 month of inventory a year ago. Now they're up 60%. So yes, it's a fast increase, but off the low baseline, you have to have a good reference for that. BC, 21% increase in inventory year over year. Okay, but remember, GVRD is flatline. We're going to see almost exactly the same amount of active listings this month as we saw last month once the dust settles here in a couple of days. So similarly to Ontario, it's like Ryan said, it's sort of the outlying or the further away from the core that is seeing the greatest increases. Your Fraser Valleys, your Whistlers, your Vancouver Islands, those are the areas that are seeing the big jumps in inventory. So as a whole, the province is up about 21%. Interestingly, when you look across Canada, the sales to new listings ratio is actually the lowest in 7 years. So that's going to start changing things as well. So what's that doing to prices naturally? Obviously, they're going to go down as well. HPI for Canada posted the largest monthly decline dating back to 2005. It went down a full 2%, or about 1.9% last month in June. So, and again, remember, HPI doesn't fully capture the fast-moving market. So realistically, nationally, I'm sure we dropped more than 2%, but that's what it's going to show for the month. We're going to see another decline in July here, obviously. As an example, because the HPI doesn't capture these fast-moving markets, if we take a look at it a slightly different way here, seasonally adjusted and weighted average prices, we saw the largest quarterly decline dating back to 1990, 32 years ago, of 8% decline.
Wow.
In house prices.
Wow.
That's in 3 months. I mean, you can imagine if you were to extrapolate that over a year, you'd be looking at a 32% drop if it were to continue at that pace, looking at it with that metric. Anyway, moving on. Ontario, which was the frothiest, is now the coldest. It is dropping like crazy, especially in the cottage countries. For example, some areas have dropped 11% month over month.
Holy cow.
1 month. And again, that's HPI. So this is, it could be even further. We're gonna see similar things happen here in, again, the further away, the smaller areas like the Sunshine Coast, possibly, maybe the interior might see some kind of cottage country areas see those big declines. We have yet to see the data come in, but again, we act so similarly to Ontario with those type of price metrics. Okay, so where are we at? Even with all these price declines and new inventory, total months of inventory on the market sits at 3.1. which is still way less than the average long-term average of about 5.5. So there's currently no oversupply. There's no panic selling that we're seeing out in the marketplace. Things are trending up, but again, like we're seeing here in Vancouver, there's a lot of stalemate going on. There's a lot of market freeze.
Interesting.
Well, yeah, go ahead.
I was just gonna comment on kind of the picture you just painted, Dan. It's kind of like a watering hole in a desert. It's like you've got, the further and further away you go from the watering hole, the more and more risky you get, right? Mm-hmm. And I think that that's something to really think about. And people are always like, well, why Vancouver? Well, it's where the jobs are, right? It's where the high-paying jobs are. It's where the concentration of people are, right? So the further and further you get away from that, the demand factors, the supply factors, the pricing factors, all of these things weight differently as you get further and further away from that center. So I just thought I'd mention that, because what you just painted is literally, the further away from the watering hole you get, the closer you might get to death.
Yeah, no, it's a good analogy, and you got to think, right? Because it was a year and a half ago that people were like, okay, well, I can't travel. We're all flush with cash, and rates are rock bottom. So let's go buy a vacation home, in cottage country.
Made sense.
And now that has flipped, what's the first thing you're going to offload? If it's going to be this increased payment, it's 55% higher than when you bought it. If you're a variable, for example, you're going to offload that asset because it's likely become a liability for you. Mm-hmm. So that's why we're seeing these extreme price reductions in areas like that. And understandably, with all of this, real estate sentiment is getting hammered. It was about early 2021 when it peaked. Sentiment, again, how people feel about buying real estate. It was up around 69%. People felt very confident in real estate overall, in the values of their homes and buying homes, etc. That is now down to a 7-year low of 29%. So we've seen a massive shift. I mean, it's been cut in more than half in just about 16 months here. And this is all, probably just dropped off almost since the beginning of this year with all the rate hikes. One side note here. When prices go down, we always talk about the government stimulating it, and at what point do they panic? And here's the reason why you're likely going to see this in the near future. The BC government is very drunk on their property transfer tax. If you take your $1.2 million average home price, they make $22,000 for every transaction on PTT. Okay, they'll get an extra $60,000 if there's GST as well, so $82,000 per. But anyway, let's just focus on the PTT, the property transfer tax, for now.
We're not talking about affordability, right, Dan? We're talking.
Yeah, right. Yeah.
Sorry, that's a different conversation.
So if we take our 1,920-ish sales in the month of July here, that's $42 million in property transfer tax our provincial government's going to take in. But that was 40% more just a year ago. So who's going to be the most motivated to turn this market around? Okay, the government makes more on a real estate sale than realtors, than lawyers, than inspectors, of course, everybody. The highest profiting, entity within a real estate transaction is our government. Mm-hmm. So yes, they are, you got to think too, residential investment now accounts for 10% of GDP here in Canada.
Yeah.
So when sales drop to 40-year lows or whatever it's going to be here, they're going to look to ways to turn it around because the government likes their money as much as anybody else. And they seem to have levers to pull to ensure that they're going to get it.
Well, and in 2021, the provincial government recorded $3 billion in total property transfer tax, right? So if sales drop more than prices, right, the volume of sales continues to fall, their taxable revenue falls off the chart. And they can't have that. They can't pay for all the services that they're promising everyone, right? And without money coming in, I mean, unless they're going to go after income tax, but that's not going to help either with negative wage growth. But anyways, we can get into that later. Staggering amounts of money made by the government for really providing not a whole lot of help in terms of affordability here. Also, let's touch on immigration, because immigration might be the savior here. It certainly is if we If we take out new immigration and we look at natural population growth, something happened this quarter that we've never seen before. The number of deaths basically equaled the number of births in Canada, which meant our natural increase fell to 0. So that needs to set in for a second here. In other words, there's no increase in the Canadian population outside of immigration. So thank God for immigration. People just, they're not having the same amount of kids as they were, and rightfully so. It's so expensive to add a bedroom. And the average bedroom, additional bedroom in Canada amounts to $500,000. Families are going to be like, do I want to have 1 kid or 2 kids? Well, we can't afford to. And I guarantee you they're having those conversations. I know I did when I had my children, right? Anyhow, let's talk about Ontario, because it's showed the worst net interprovincial migration at nearly minus 40,000. That means 40,000 people left Ontario in Q2 of 2022, right? By comparison, in Q1 of 2017, they grew by 15,000. So in 5 short years, that has turned negative substantially. Where are these people going, right? If they're not leaving Canada, then they are going to Atlantic Canada, or they're going to the prairies where things are far more affordable. And that's just a reality. These major centers are becoming so difficult to live in because of the costs of affordability. But let's talk about international immigration, because Canada set a new record, bringing in over 400,000 new permanent residents. That's the highest ever on record. And when you consider things like international students, which make up, and the birth and death rate of all Canadians, our natural population growth sits just above 500,000, which isn't far from our all-time high captured in 2019, which was just under 600,000, right? So there's a large number of international students that make up that demographic, roughly about 170,000 this year. So anyways, that's a big driver for demand, for rental demand, I should say, in our big cities. So it's a number we should be taking account of as well.
So if this many people are coming into the country and fewer people are buying homes right now, where are they living? Mm-hmm. Well, obviously rental homes, rental market. And the rental rates, understandably, with that level of demand, are absolutely booming. And not only are they booming, but the competition to get into properties is almost out of control. We hear, many stories, multitude of stories here from people submitting their applications for a rental unit, 50 other applications, 100 applications sometimes. It's brutal out there. If you thought buying a home was hard 6 months ago, try renting a home right now. And on top of that, well, Toronto, for example, just registered a 23% rental rate increase year over year. Obviously, with that demand, prices go up. So it's not easy in that market either way. If you want to rent, you're getting squeezed. If you want to buy, you're getting squeezed. Canadian real estate, regardless, it is tough. It's a sad story right now.
Yeah, and I don't think it ends there too. I took a note out here. This is very interesting. A report that was generated by the Toronto City Council detailing the planning department, saying that they can't find and retain talent and now have a 13% job vacancy rate because they can't afford to pay employees enough. And to give you some other perspective, that's they have turned over 25% of their workforce since 2020.
Wow.
So, not even the government can keep people right now or find people. So this affordability thing, it's absurd, in my opinion, right now, and probably is a large reason as to why people's sentiment around Canadian housing is the lowest it's been in a long time, right? We'll touch on construction as well. Housing starts across the country have jumped by 13% in Q2. That puts us at about 270,000 new units on an annualized basis. Even accounting for strong population growth, that's a significant amount of supply. Dan, I would say about 50% of that supply is rental purpose built only, right? So not going to help with people who are trying to buy a home, generally speaking. Also indicates, probably another indicator as to why, our inventory levels haven't risen beyond kind of where they're at now. We just don't have the new home supply coming on as well, especially when 50% are going to rentals, right?
Mm-hmm. Yeah, exactly. Now, for the people who are buying homes, as mortgages are getting more expensive, the payments are getting higher because of the higher interest rates on your mortgage. So many people this year have, of course, been pushed into variable because their buying power, in essence, increases because that rate is different. It's lower. Your payment is lower for buying the same home. So far this year, about 54% of new mortgages were variable. This makes today's total of all mortgages across Canada about 33%. About 1 in 3 mortgages is variable. 2 years ago, in 2020, that was only 18%.
Whoa.
So there is a major shift in how people are looking at mortgage rates. And of course, whether they go fixed or variable. And of course, as rates increased, the amount of people that are going to be, susceptible to things like the trigger rate that we touched on the last couple episodes here. So we're keeping a big eye on that, because if 1 in 3 people are going to be radically affected by greatly increasing interest rates, there's going to be public pressure to put a cap on how high they go. And again, this is when we talk about the other levers that can be pulled. 40-year amortizations, lower deposits on investment properties or whatnot. We'll see which way they go, but just know that there's the highest amount of people, I guess, probably ever have variable rate mortgages here in Canada. And so they are a lot more susceptible to interest rate changes. There are going to be some pretty loud voices in the upcoming years here. The 5-year fixed the 5-year fixed to variable spread right now, it's about 100 basis points. This is down from when it was 225 basis points at the beginning of this year. So you can imagine that difference. Do you want to pay 2.5% or do you want to pay 4.75%? And obviously that's why people were being pushed, quote unquote, into variable mortgages, because they were enticed by what was then lower payments. But this said, people are still buying homes. There are still a lot of people that are getting new mortgages, up 10%. So much so year over year from last May as the current data we have. So 10% more mortgages are applied for last May than the May previous. That is lower than the 14-year high of 11% that we saw earlier this year, but do expect this number to drop pretty significantly, I believe, for the rest of the year. I think new mortgage applications will drop significantly based on these higher rates. And again, a lot of the freeze that we're seeing in the marketplace.
Yeah, and I think as we'll touch on this a little bit here, but as insolvencies maybe start to rise, as the cost of everything else in someone's life begins to rise, HELOCs get more expensive, you're going to see the application for mortgages drop as well. It's just inevitable. What's really crazy, let's talk about the consumer for a second here. If we think about it, roughly about a year ago, households were paying about 2.5% average interest rates across all of their outstanding debt, right? Credit cards, auto loans, mortgages, etc. That's now at least, just about 5% on average, right? So it's doubled. That's the steepest one-year move in it since at least the 90s. And like I just said, there's no way that these rising interest rates aren't going to crimp spending. They have to. People are going to run out of money. They're not going to be able to buy the things that they want or could have done over the past couple of years without the free flow of credit, right? Interestingly, unemployment continued to drop despite shedding some jobs. The unemployment rate actually fell to a fresh record low of just 4.9%. This is the first time on record we've seen an unemployment rate with a 4 in it. So, it is good news But, if we still have GDP contraction and we have wage growth taking place, then we're headed towards stagflation, and that's kind of scary, right? So where we're headed is more important than maybe just where we are. And that kind of gets to my next point. Even though wages have gone up by 5.6% compared to last year, with inflation running at 8.1%, that's a real negative wage growth of minus 2.5%. So talking about, Toronto City Council having issues with people spending probably more than 35% on just the cost of living, right? Let alone, if they've got a mortgage, they'll be upwards of 55%, right? So, wages are not keeping up with, in this respect, inflation, and as such are causing a negative wealth effect, right? Credit cards, consumers may be drawing on their savings more than they used to. Consumer credit is also being consumed, and this is likely just to stay afloat. We're seeing credit cards and HELOC debt, it rose by 5% in just the last 3 months, right? So again, that continues to go and compound. That gets scary pretty quick. Lastly, I'll just touch on some insolvencies. They're still 40% below their pre-pandemic levels, which is great. But signs of that staying there are no longer the case, right? So year over year, we've seen insolvencies rise by about 13.3%. Again, it's early data, so it depends. We're not quite sure where it's going to go in terms of its trajectory, but it's the first uptick in some time. And insolvencies and credit, going the wrong way, it's going to get worse before it gets better, right? So, a couple other things I want to just touch on just quickly here. I want to talk quickly about activity in the offices of real estate agents and brokers. There's an interesting article that came out and back in April of this year. Real estates and brokers, in terms of their contraction or expansion, their business contracted roughly 15% on average, right? So the rising costs of borrowing, cooling of the resale market, Ontario, BC, and parts of Alberta are showing the biggest declines right now in activity in real estate offices, right? So it's coming. It's not here yet because it's taking, a lot of this data is latent, right? But it's coming, right?
To that point, real quick, Ryan, I think that the numbers were for June, something like 6,500 units sold in Toronto. Meanwhile, there's 65,000 agents.
Holy cow.
That's only one deal for every 10 agents on average last month.
That's insane. We do have one of the bigger attrition rates in our industry, and you can see why. Setting aside the COVID lockdowns, this drop in the agent and broker offices is the largest since the financial crisis. So that should bring some context in terms of how quickly our market is cooling off here, right? And I think, part of this has to come back to, affordability and what's happening with our interest rates. And again, coming back to our Trudeau government who has been so eloquent in saying that they don't care about monetary policy. Well, now we're having to pay for it, right? Anyhow, as a result, like Dan touched on earlier, sentiment towards real estate in Canada is souring. And it's at the weakest level since 2015. Scary.
Yeah. So, Canada, obviously the picture is pretty bleak here. I think the vision of the roaring 20s is shifting into the crying 20s or whatever it's going to be called. We don't know here. But again, we're seeing there's some interesting signs here that, again, Vancouver real estate is resilient and will buck the national trend yet again. Okay, we're seeing prices in July flatline, while they're likely dropping almost everywhere else. Again, we're talking GVRD, not like all of BC, right? Vancouver here proper. we are seeing early signs that inflation has peaked. We've seen the 5-year bond come down. We're seeing some interest rate or some mortgage rates come down. Again, there's some slight silver lining here. And again, I'm not trying to spin anything that isn't true or real here, because most of it is, of course, on the dark side. But again, cycles are happening quicker and tighter than they ever have before. So we're going to keep a quick eye on it. You're going to hear about it here first. But Vancouver is resilient, and I think we're going to see similar information in August. I think it's going to be very slow, but I think prices are only going to dip slightly, and again, way less than the national average. And
I think I want to leave everybody with this last thought, because I think it's interesting. You know, a lot of people in terms of the comments that we've seen on our YouTube channel and the feedback that, you know, the positions people are taking, a lot of people are either thinking that inflation is going to, you know, kill the housing sector. And I want to bring it into, you know, a lot of them, also say that, you know, well, I went through the inflation in the 80s, and I've seen what can happen. And, you know, so a couple of points to that, right? When inflation was sky high in the 80s, it took 2 years before the central bank actually reacted to it. So that's one thing, right? That's when inflation was already at the numbers we're seeing today. It took 2 years before they responded to that. Number two, in the States, in 1973, when inflation was starting to go crazy, and Volcker was the head of the Fed chair at that point, in interest rates were sitting at about 6%. At the start of the year, and just about 8 months later, they were at 10%. So while we are going through some aggressive rate hikes right now, it's nothing compared to what we saw 40 years ago. And I want to put that into perspective for some people, because it's easy to get lost in the doom and gloom and the negative news, but it's not as bad as it was. And I think it's important to recognize that, and that there's also a lot of good fundamental economics that are taking place in Canada in terms of immigration, low unemployment, and other underlying factors that we have to just get through this. When we get through it, we'll come out the other side in a much better place.
Perfect. Very well said. And that's just it. Always look to the macro to understand what's happening in the micro. And sometimes that means looking back 40, 50 years for perspective, because perspective is key in every market. You know, being reactionary from the headline you read today isn't going to serve anybody. So always look to the big picture, get lots of data. And hey, we're happy to be here and be one of those sources for you. So thanks as always for watching and listening. We will see you next week. Bye.